This is Chanel Bunger with the Becker Private Equity and Business Podcast, and today I'm excited to speak with regular guest Matt Wolf from RSM, who joins us weekly to discuss economic trends that he's keeping an eye on. Matt, thank you as always for joining me today. Would you please take it away and quickly introduce yourself and then tell us about some of the things that you're seeing out there?
Yeah, thanks, Chanel. Matt Wolf, I'm a director and senior healthcare analyst at RSM. I focus on the economy and particularly private equity, and do a lot of research in the area and serve clients in the area too. So kind of blend my regular conversations and my research into perspectives that I'm very fortunate to get to share with you and Scott on this podcast every week. As we record this, we're hot off the heels of a FOMC decision to maintain interest rates, which was fairly expected. I think the big decisions will be next year as we see hopefully continued easing of inflation data that may result in some potential rate decreases. Not back to a 0% Fed funds rate, but maybe more towards a 3 to 3.5% rate. And I know a lot of private equity sponsors are breathing a sigh of relief as we see constant PIK or NAV fund financing trying to provide liquidity in the short term, and hope that over the long term interest rates perhaps subside again, not back to where they were in the run up to the pandemic, but something a little easier for portfolio companies to manage as we try to boost revenue, boost margins, and like they say, timing is everything, right? So we're watching the sort of timing of the credit cycle within the private equity environment with respect to interest rates, but also on the other hand, looking forward to the funds reporting, right? So we're now entering the time of the year where funds are preparing not only last quarter's report, but then annual reports where they will be marking investments to market and communicating that information with their LPs. And what we've seen, what we typically see in the cycle is that there's a lag between private equity valuations and public equity valuations, right? So as public markets move, those private valuations move on some sort of a delay. It's somewhere between 6 and 18 months, kind of depending on the sector, size of the fund. There's a variety of factors that play into that. And we expect to see a lot, and again, they're generally private, except for some of the largest mega cap publicly traded private equity firms. But what we expect to see based on the information we have available and conversations we've had and other research is that we will see markdowns in private equity investments, and that will have a knock-on effect into the already sort of strained fundraising environment for new funds, and will continue to be sort of a headwind for private equity in general as an asset class. So while the interest rate environment may begin to provide a little bit of a relief in 2024, probably before then, we're going to see some write-downs and some realization of lower returns than sponsors would like, and that may have a cascading effect into fundraising of new funds, and we may see more LPs allocate more money away from private equity. I don't think it's going to go away as an asset class, certainly not, and there still is an incredible amount of dry powder. However, as we look out over the next 3 to 12 months, there are definitely some headwinds that remain for the asset class, not only in the interest rate environment side, but also on the fundraising side. And we'll be watching to see how that all shakes out really over the next 3 months or so.
Got it. And is there anything else that you want the listeners to hear today?
Oh, there's so much. We could talk for hours, but let's leave it there for today.
All righty. Well, thank you as always for joining me today on the Becker Private Equity and Business Podcast. It's always a pleasure. Thank you.
Thank you.